Right now, a highly targeted, invisible sniper is taking aim at the most profitable sectors of the global economy. And if you are holding standard technology stocks, your retirement portfolio is sitting right in the crosshairs. You might think you understand the current economic environment because you watch the news, but the reality is that the financial media is completely missing the real story. We are not just facing another standard day of market volatility. According to top Wall Street strategists at major firms like Evercore ISI, we are rapidly approaching what they call a market inflection point, driven by a deeply hidden vulnerability in the global supply chain. To understand what an inflection point truly is, we need to step away from finance for a second and look at mathematics and physics. Imagine you are riding a massive roller coaster. You are clicking slowly up the steepest, most terrifying hill of the ride. That upward climb is like a long, steady bull market. But eventually, you reach the very top. There is a precise, breathless fraction of a second where the coaster stops climbing, but has not quite started falling yet. The gravity is shifting. The momentum is reversing. That exact microsecond of suspended animation, where the entire direction of the system changes, is an inflection point. In the stock market, an inflection point represents a period of maximum uncertainty. It is the moment when the old rules suddenly stop working. The herd panics, and the smartest investors on the planet prepare to make their most aggressive moves. And right now, the trigger for our current inflection point is a violent, sudden surge in the prices of highly specific, incredibly obscure commodities. Most people understand general inflation. Think of normal inflation like a leaky pipe in the basement of your house. It is annoying. It causes slow damage over time. It makes your water bill go up a little bit every month. And eventually, you have to call a plumber to fix it. That is how we experience the rising cost of groceries or gasoline. But what is happening right now in the commodity markets is not a leaky pipe. It is a highly concentrated, incredibly powerful laser beam, cutting directly through the main structural support, pillars of the artificial intelligence and defense industries. The global supply chain for high-tech manufacturing is entirely dependent on a handful of niche materials. We are talking about elements like gallium, germanium, and antimony. You probably have not thought about these elements since your high school chemistry class, but they are the absolute lifeblood of the modern technological world. And right now, the global supply of these critical metals is almost entirely controlled by one single nation, which is China. To understand how dangerous this is, we have to look back at one of the most brilliant and aggressive geopolitical economic strategies in modern history. We have to go back to 1992. At that time, the paramount leader of China was a man named Deng Xiaoping. He was the architect of China's modern economic miracle. During a tour of southern China, Deng Xiaoping made a very famous, very calculated statement. He said, "The Middle East has oil, but China has rare earths." This was not a passing comment. It was a declaration of a multi-decade, ruthless strategy to monopolize the future. Over the next 30 years, China systematically took over the global supply chain. For these critical minerals, they did not just happen to have a lot of rocks in the ground. They executed a masterclass in market domination. They heavily subsidized their state-owned mining operations. They built massive, highly toxic chemical processing facilities that Western nations simply did not want in their own backyards due to environmental regulations. But most importantly, they intentionally flooded the global market with these metals at prices so ridiculously low that every single competing mine in the United States, in Europe, and in Australia was forced to declare bankruptcy and shut down. By the early 2000s, China had established a virtual stranglehold on the materials required to build the future. Let us break down why these specific metals are so impossibly important today. We hear a lot about semiconductors and microchips. When you think about a company like NVIDIA creating the chips that power generative artificial intelligence, you might think they are just making tiny pieces of silicon. But the reality of modern computing is vastly more complicated. Making a cutting-edge microchip is like baking a microscopic cake that has 100 different layers, and every single layer has to be perfectly aligned, down to the width of a single atom. As these chips get more powerful, they generate an incredible amount of heat. Silicon, the traditional ingredient, simply cannot handle the extreme electrical currents required by modern artificial intelligence servers or advanced military radar systems. If you run that much power through basic silicon, it will literally melt. This is where those obscure Chinese metals come in. Materials like gallium are used to create compounds like gallium nitride. Gallium nitride can conduct electricity far more efficiently than silicon, and it can survive massive amounts of heat. Without gallium, you cannot build the high-speed chargers for electric vehicles, you cannot build the advanced antennas for 5G cellular networks, and you absolutely cannot build the next generation of artificial intelligence hardware. The exact same vulnerability exists in the defense sector. Consider the F-35 Lightning II, which is the most advanced stealth fighter jet ever created by the United States military. A single F-35 fighter jet requires approximately 920 pounds of rare earth materials and highly specialized niche metals to function. These metals are inside the targeting lasers, the advanced radar jamming equipment, the electrical systems, and the super magnets that control the flight surfaces. If the supply of these materials is disrupted, the assembly lines for the most important military hardware on the planet grind to a complete halt. And this is exactly why the recent price surges in. These commodities are causing such massive panic behind the scenes. The news headlines are currently focused on geopolitical tensions involving Iran, but smart investors know that the conflict in the Middle East is just an accelerant. It is throwing gasoline on a fire that was already burning. The tension in the Middle East disrupts global shipping lanes, increases insurance costs for massive cargo vessels, and creates a generalized atmosphere of fear. This geopolitical chaos provides the perfect smokescreen for a supply chain squeeze. When the cost of gallium and germanium skyrockets, it directly attacks the profit margins of the biggest technology companies in the world. It is a targeted inflationary shock. We have actually seen this exact economic nightmare play out before, and history provides a perfect roadmap for what happens next. We have to travel back in time to October of 1973. The world was about to experience one of the most severe, earth-shattering economic shocks of the 20th century. The Yom Kippur War broke out in the Middle East as a coalition of Arab states launched a surprise attack on Israel in response to the United States providing military support to the Israeli government. The Organization of Arab Petroleum Exporting Countries, known as OPEC, decided to weaponize their greatest asset. Led by King Faisal of Saudi Arabia, OPEC launched a devastating economic embargo against the United States and its allies. They simply turned off the oil taps. The results were instantaneous and catastrophic. The price of a barrel of oil skyrocketed by an astonishing 400% in a matter of months. If you were alive back then, you remember the absolute chaos that paralyzed the country. There were lines of cars stretching for miles down the highway just to get a few gallons of heavily rationed gasoline. People were physically fighting each other at the gas pumps. The stock market went into a total freefall. The S&P 500 plunged, wiping out billions of dollars in wealth. The global economy entered a brutal period known as stagflation, where economic growth stopped completely. But inflation continued to soar out of control. It felt like the end of the American economic empire. But here is the absolute, most important secret that history teaches us about that moment. The 1973 oil embargo did not permanently destroy the global economy. It acted as a brutal, terrifying, but ultimately temporary inflection point. It forced an incredible, desperate wave of human innovation. That crisis led to the creation of the Strategic Petroleum Reserve. It birthed the modern energy efficiency movement. It pushed automakers to design smaller and more efficient engines. And most importantly, the investors who had the psychological fortitude to buy shares of great American companies during the absolute darkest, most terrifying days of that crash went on to build generational wealth over the next decade. The herd panicked and sold everything at the bottom, but the smart money bought the dip. So why does the herd always panic? Why do highly intelligent, rational people look at a red screen on their brokerage app and immediately hit the sell button, locking in their permanent losses? To understand the devastating psychology of a market crash, we have to look at the groundbreaking work of a brilliant psychologist named Daniel Kahneman. Kahneman actually won the Nobel Prize in economics for basically proving that human beings are absolutely terrible at making rational financial decisions when they are under stress. Kahneman wrote a legendary book called Thinking Fast and Slow, where he outlined a revolutionary theory about human cognition. He proved that our brains essentially have two very different operating systems, which he simply called System 1 and System 2. System 1 is our ancient, primitive, evolutionary brain. It is incredibly fast, it operates automatically, it is highly emotional, and it is completely reactive. It is the exact part of your brain that kept your caveman ancestors alive. If an early human was walking through the savannah and heard a twig snap in the tall grass. System 1 did not stop to analyze the wind, speed, or calculate the probability of a threat. System 1 just screamed, "Run away right now, there is a lion." It is a pure fight-or-flight survival mechanism. System 2, on the other hand, is the modern, logical, calculating, and rational part of your brain. It is the part that solves complex math equations, builds spreadsheets, and plans for the future. But System 2 has a fatal flaw. It is incredibly slow, it is very lazy, and it requires a massive amount of biological energy to activate. When you turn on the financial news, and the pundits are screaming about geopolitical tensions, soaring commodity prices, and an imminent market crash, your ancient System 1 brain completely hijacks your body. It does not understand that a stock market correction is a temporary fluctuation in paper wealth. Your System 1 brain perceives the dropping numbers on your screen as a literal, physical threat to your survival. It triggers the exact same chemical dump of adrenaline and cortisol, as if a lion were chasing you through the jungle. That is why the retail herd sells everything indiscriminately during a panic. They are not making a financial decision. They are running from the tiger. But the smart money, the elite institutional investors like Evercore ISI, who are currently preparing to deploy massive amounts of capital into this upcoming market drop, operate completely differently. They have spent years training themselves to suppress their emotional System 1 brain and intentionally activate their logical System 2 brain during a crisis. They practice a philosophy that the legendary value investor Sir John Templeton called the principle of maximum pessimism. Let me tell you a story about John Templeton that will permanently change how you view market crashes. The year was 1939. The world was literally falling apart. Adolf Hitler had just invaded Poland. The grim reality of World War II was beginning to dawn on the globe, and the financial markets were in a state of absolute, unprecedented terror. Everyone was liquidating their portfolios. The fear was thick enough to cut with a knife. So what did John Templeton do? He called his broker and gave him one of the most insane, incredibly courageous orders in the history of Wall Street. He instructed his broker to buy exactly $100 worth of every single stock on the New York Stock Exchange that was currently trading for less than $1 a share. He even demanded that the broker buy shares of companies that were actively going through bankruptcy proceedings. He ended up buying 104 different companies. It was the ultimate fearless contrarian bet. Templeton believed that during a period of maximum uncertainty, the market prices assets based purely on blind emotional panic, completely detaching from the actual underlying mathematical value of the businesses. And his logic was flawless. Over the next 4 years, as the American economy mobilized for the massive war effort, the overwhelming majority of those discarded penny stocks exploded in value. Templeton made an absolute fortune because he understood that the greatest financial opportunities only appear when blood is running in the streets. This exact same philosophy is the cornerstone of Warren Buffett's entire career. The newsletter explicitly mentions that, while the market is currently panicking about supply chains, Buffett is calmly attending a charity lunch, completely ignoring the daily noise of the ticker tape. Buffett operates on the legendary maxim to be fearful when others are greedy, and to be greedy only when others are fearful. We can look back at the famous salad oil scandal of 1964 to see how Buffett actually applies this. Back then, the American Express Company was caught up in a massive fraud involving millions of dollars of fake salad oil inventory. The stock price of American Express plummeted in half almost instantly. Wall Street declared the company dead, but Buffett activated his System 2 thinking. He realized that while the company had taken a massive financial hit, their core business model, the newly invented credit card, was completely intact. He went behind a cash register at a local restaurant and literally observed people still using their green American Express cards to pay for dinner. The scandal had not changed consumer behavior at all. The underlying value of the company was fine. Buffett poured 40% of his entire partnership's capital into American Express stock. while everyone else was panic selling, and it became one of the greatest investments in the history of capitalism. To achieve this level of success, you have to master a concept called second-level thinking, which was popularized by the brilliant billionaire investor Howard Marks. First-level thinking is exactly what the panicked herd does. It is simple, it is linear, and it is almost always wrong. First-level thinking looks at the news and says, commodity prices are surging. This will hurt the profit margins of technology companies. Therefore, I must sell all my technology stocks immediately. Second-level thinking is much deeper and more complex. Second-level thinking asks, what happens next? And who actually benefits from this chaos? Let us apply second-level thinking to our current supply chain crisis. If the supply of critical metals, like gallium and germanium, is restricted by China, it exposes a massive, terrifying national security vulnerability for the United States. That means the domestic defense sector and the domestic semiconductor manufacturing industry are suddenly going to become the absolute, most strategically important businesses on the face of the earth. The government will not let them fail. They will likely receive massive federal subsidies, huge priority contracts, and tremendous capital inflows. Third-level thinking takes it one step further. It realizes that the broad market sell-off, which is being driven by the panicked first-level thinkers, is actually creating a massive temporary discount on these exact same structurally critical companies. The panic is serving up the ultimate buying opportunity on a silver platter. So how do you actually protect your retirement portfolio and actively profit from this coming inflection point? You do not try to guess the future. You use a mechanical, deeply disciplined, emotionless system. We call it the 55-35-10 seesaw allocation. You keep exactly 55% of your overall portfolio, heavily invested in broad, high-quality equities, like an S&P 500 index fund. This foundational layer ensures that you fully participate in the inevitable economic recovery and long-term growth. You keep exactly 35% of your portfolio in rock, solid safe haven assets. During times of massive global geopolitical stress, global capital always frantically searches for the safest place on earth to hide. And right now, despite all the political noise and debt concerns, the ultimate safe harbor remains the United States dollar and intermediate term. United States Treasury bonds. They act as a massive, heavy shock absorber for your portfolio, keeping your total value stable when the stock market is dropping 20%. But the real magic, the absolute key to building generational wealth, happens with the final 10% of your portfolio. This is your tactical dry powder. This is pure cash. But you do not just throw this cash blindly into the market on a random Tuesday. You use a highly specific survival mechanic, known as the 50% rule of dollar cost averaging. You have to be patient. You wait for the market structure to actually break. You wait for that specific, terrifying day when the financial news channels are showing giant red banners across the screen, when everyone on social media is screaming that the sky is falling, and when Evercore's predicted inflection point finally, definitively arrives. On that exact day of maximum pessimism, you take exactly half of your cash reserve, which equals 5% of your total portfolio, and you aggressively buy the broad market. You deploy your capital straight into the teeth of the weakness. Why do you only use half of the cash? Because absolutely nobody, not even Warren Buffett, can predict the absolute bottom of a market crash. If the market continues to fall the next week, you still have the other half of your cash safely in reserve, allowing you to buy even more shares at even deeper, more incredible discounts. If the market immediately rebounds, you have successfully bought the dip at highly discounted prices, and you get to ride the wave back to the top. This 50% rule is mathematically brilliant because it completely eliminates the emotional paralysis and the terrible regret of trying to time the market perfectly. It forces you to act like an institutional titan, while the rest of the world is paralyzed by fear.